Hey guys, my name is Kevin Steel and I've worked as a fractional CFO for multiple clients over the last 5 years. And today I'm going to speak to you about one of the biggest challenges I see facing many clients. And that big challenge is cash flow. Why is cash flow such a big challenge? Well, number one, if you don't have visibility of what's happening with your cash flow, then how can you make decisions? Let's say you want to hire a new salesperson. That new salesperson, they're going to have to meet certain revenue targets, they're going to have commission, etc. And unless you can model that forward, all the different cash impacts of this, then how do you know that you've made the right decision, and how do you know if this hire will work out? So cash flow, super important, and that's what we're going to cover in this video today. And I'm going to show you two key examples here. One key example is going to be something called a 13-week cash flow forecast. And what a 13-week cash flow forecast does is it gives you visibility of your cash position in your business for the next 12 weeks. It's called a 13-week because the first week is the most recently completed week. So this is looking at cash on a granular basis, week by week, for the next 12 weeks. And what that means is you will not get any surprises in the short term. When it comes to long-term cash flow forecasting, then what we do is we build a much longer term plan. It can be anywhere 12 to 18 months, but we know from running businesses that everything's unpredictable. There is no way we can accurately model cash for 18 months in the future. I mean, imagine it. Look at your business at the moment. You're trying to predict how much cash you're going to have in the bank in 18 months. Imagine all the different things that could happen between now and months 18. It's going to be impossible. But we can get fairly accurate in the short term. That's what a 13-week cash flow forecast is. But we can kind of go for a rolling average for the long term. So at least we've got an idea of what future decisions we can make. And that's what we're going to cover in this video today. Why does uncertainty about cash make it so hard to make decisions? Well, one thing is fear of the unknown. And this is a big thing. So cash in a business has a huge kind of emotional attachment to it. Because if you can't accurately track your cash on the short and medium term, then you're kind of stuck in that almost a doom loop. You're almost like, can I afford this hire? Can I afford this piece of equipment? Does that mean I'll still be able to pay my tax bill? Will I be able to sleep easy at night knowing I've got enough money? So cash flow is not only really important from a pure business standpoint, but it's also important for you as a business owner on an emotional and psychological standpoint, so you can feel safe to make decisions that are going to push your business forward. If you do not have that sense of security that a fractional CFO like my good self can bring to you, then you need a fractional CFO, because that's the kind of stuff they help with. So let's ask a really important question here. What do most business owners misunderstand about cash? This is best answered by way of me talking you through a really quick example. The answer to the question is profit is not cash. That is the answer to the question. But let's actually show that in a worked example. So here's our worked example. So this is a made-up company called Acme Consulting Limited, and it has some revenue, it has some costs of sales, it has a gross profit, it has some overheads, so people, premises, professional admin, sales and marketing, all the normal stuff you'd expect. And then we have down at the bottom our operating profit. So what's left in the business after all revenue minus all costs? That's our operating profit. Now, you would be very surprised at the amount of people who might think, okay, this is how much cash I have available. That would be an incorrect assumption. Let's show why. So we have our operating profit, but as a business owner, we know that profit needs taxed. So if we put in a tax line, and let's say 25% tax, so this is our profit after tax. So profit after tax, this is the amount of money a company has left to pay for things that are not on the profit and loss account. So what's not on the profit and loss account? One thing is dividends. If you own a business, you may withdraw dividends instead of salary, and they are not shown in the profit and loss. So now we need to take out dividends. So let's say you're withdrawing dividends and 60 a year. Now we have profit after dividends, And you can see there just the difference between taking away our tax and taking away our dividends. We're already 339,000 down on our operating profit. But there is more. So if the business has a loan repayment, only the interest element appears on the profit and loss. The capital element of the loan repayments does not appear. So if you're paying back a loan, let's say the capital element is, I don't know, 2,000 a month. So loan repayment capital, 2,000 a month times 12 months. That's another 24 coming off. So profit after dividends and loan. So now we're down even more. We're down to 7,528.50. What else? Purchases of assets do not appear on the profit and loss account unless they're extremely low. So let's say this company, they bought, I don't know, 50,000 of computer equipment. Computer equipment, 50,000. And then we deduct that there, total. So the total cash availability for this business has actually dropped from what one might think, 1.15 million, all the way down to 702, which is 412,000 less than the profit that is shown for the business this year. And this is a real common trap that some business owners fall into. Remember, all your costs do not appear on the profit and loss account. You have to take into account tax, dividends, loan repayments, purchases of assets. There are numerous other balance sheet items that will appear here, but for the sake of simplicity, let's just focus on those ones. But I hope you get the idea. Cash is not managed from the profit and loss account. There are other things that are coming into cash. Okay, so with all of that in mind, I am now going to share my screen again, and I'm going to talk you through how cash works. We're going to talk about cash in three different horizons. We're going to talk about short term, medium term, and long term. And also what I'm going to do is I'm going to show you how to create a short term 13-week cash flow forecast. Even if you don't create it yourself, I think this is kind of really useful to know because it could be something you could maybe ask your accountant to implement, or if you have a particularly complex operation, it's something you could perhaps even ask a fractional CFO to implement. And if you do want to ask a fractional CFO, could be me, could be somebody else. Probably a good idea if it's me. Then you can check the link below in the description. You'll see my LinkedIn. What I do is I do a free and full business analysis for every single client that contacts me. There's a lot of people that say they're fractional CFOs. I like to prove up front I'm the right guy for the job. So what I do is I give you a full business analysis up front. So let's share screen and let's talk through how cash works. So what we have here is an overview of how cash works. So this is an example of how cash should flow over an 18-month period for a made-up company called Acme Consulting Limited. So in months 1 to 3, we should have a pretty good idea and a high confidence level of what's going to happen with cash in this business. Months 4 to 9, we've got a kind of moderate idea of confidence. We can have a look at our sales pipeline, renewal patterns, committed costs, etc. But the variance is a little bit higher, so maybe between 15 25%, sometimes even higher. And then we get on to the long term, months 10 to 18. Nobody knows what's going to happen in month 10 or month 18. This is useful for kind of spotting trends and planning, but the exact cash balance 18 months out it's unknowable. Anything could happen between now and the next 18 months. AI could have taken over the world by then, and we could all just be we could be working for AI instead of AI working for us. Who knows? A lot can happen in 18 months. And here we can see a visualization, high confidence, first 3 months, moderate confidence, next period, low confidence, period after that. And the way cash works is it's basically the amount of cash received into all bank accounts in 1 month minus the amount of cash spent in all bank accounts and credit cards, etc., in 1 month. And this is a visualization of how cash would flow. And the key point of this forecast, just to mention down the bottom, it's not to predict the future precisely. We cannot do that. It's to spot the shape of what's coming. What are the pinch points? When do you need a buffer? What decisions do we need to make to avoid problems? But the 13-week cash flow gives us precision. The 18 months gives us direction. It would be completely outside of the scope of this video for me to work through an 18-month cash flow forecast. We'd probably need about a 3-hour video to do that. But what we can do is we can briefly cover a 13-week cash flow. And remember, a 13-week cash flow is what should be pretty precise, and our variance on what we expect to happen compared to what actually did happen should be about 5% either way. So this is a 13-week cash flow forecast template. So it's called 13 weeks, but the first week is actually the most recently completed week. And then we flow forward from week 1 all the way out to week 12. So this is actually very simple. It doesn't require huge accounting knowledge, huge finance technical knowledge. All we're doing is plotting what is going to be received into our bank account and what we are going to spend out of our bank accounts. So for example, in this one, we have our opening cash balance up the top. Trade debtor collections, what that simply means is a client paying us money into our bank account. Cash or card sales, any sales done in cash, quite rare these days, or card sales made through, if you're a restaurant, for example, card sales, they would come into that line. Any other income, and then we have any tax refunds, grant incomes, etc. And if we received any loans or investments, we would include this here. It's simply what money do we expect to come into the bank account. And we should be able to plot that fairly accurately for the next 13 weeks, because what we do is we update this weekly. So it's a rolling forecast every 12 weeks looking forward. So if we're not sure of anything currently on week 12, maybe next week we've got a lot more accuracy on week 12 and everything just rolls forward. So it's a constantly living and evolving document. And on the outflow side of things, just everything we expect to leave our bank account each week. So we're paying our suppliers, we're paying our staff, we're paying any tax liabilities, we're paying our monthly rent, we're paying our monthly phone bill, we're paying our monthly insurance, we're maybe paying £500 a month for Google Ads, whatever. We pay a monthly loan repayment, and then just an other / Sunday payments for like coffees, trains, that kind of thing. Never going to be exact, but we should have a pretty good idea over the next few weeks if we're going to be traveling. And then we have our closing cash balance, and then we can see the kind of movement between cash each week. And the 13-week cash flow spreadsheet, that will help us track our cash balance over the next 13 weeks. So we've got a high level of confidence in our cash balance. If you're a business owner and you do not have a 13-week cash flow forecast, I would strongly advise you to get one in place. This is the kind of thing that helps you sleep well at night. You can look at this 13-week cash flow and go, okay, fine. I know I'm not going to run out of money in the next 3 months. Or the flip side is you could look at this and go, oh, damn, I'm going to run out of money in the next 3 months. And what that means is that buys you time to make decisions. If you know about a problem now that's going to happen in 3 months, you can take steps to fix it. If you don't know about a problem that's going to happen in 3 months, then it happens. You do not have time to react. If you don't have time to react, that could be the difference between your business having some big financial trouble or you having the opportunity to get ahead of the problem and make decisions that will help improve your cash position. So now that we've walked through a number of things, how cash works on a short, medium, long-term basis, and what a 13-week cash flow looks like, the question you might be asking yourself is, how do I get a 13-week cash flow? If you're a business over 1 million revenue, you're going to have a lot of transactions, lots of money coming in, lots of money going out, lots of moving parts. As the owner of the business, you do not have time to do that. As a business owner, your primary responsibilities are number 1, looking after your team, and number 2, growing the business. So what you need to do is you need to get a finance professional to handle this for you. If you're a business under 1 million revenue, your accountant, bookkeeper will likely be able to help you with this. But if you're a business kind of over 1 to 2 million revenue, then you need a finance professional to come and help you with a 13-week cash flow. That is what a fractional CFO does in part. Well, it's one part of what a fractional CFO does amongst a whole suite of other things. The main thing about a fractional CFO is linking finance to strategy. And cash is a huge part of linking finance to strategy. Unless we have cash visibility, what's happening in the short, medium, and long term, we cannot make strategic decisions. So that's why cash flow is so important. And 13-week cash flow is really important. So we are monitoring that 3-month period to make sure there's no nasty surprises happening. Fractional CFO will help you stay on top of all this stuff, make sure your 13-week cash flow is as accurate as possible, but will also help you build out a long-term forecast, 12, 18 months. So we've got a direction of the business, how the cash is flowing, and how we can make decisions to increase profitability and make everybody happy, and most importantly, not run out of cash. So today in this video, we have covered a 13-week cash flow and long-term cash flow forecasting, why it's important. Your next question might be, how do I do this? And do I need a fractional CFO for this? Well, in the next video, what we're going to do is I'm going to cover what a fractional CFO should be doing in the first 90 days of working with you. And that video will give you a really good idea if you need a fractional CFO or not and how they can help you manage your cash.